So we talked about merchandising companies, right? Yes. Sorry? Yes, we talked about multiple step income statements. We talked about basically how to calculate cost of goods sold. We learned how to make the journal entries based on the perpetual system, right? Okay. Now, so let's just, this is the Excel file that I already uploaded on Blackboard. I already uploaded this one to Blackboard. So this is similar to what you might have as problem in the homework, and this is what you need to learn and basically how to make the journal entries. Remember, second exam will be mostly about journal entries and computations. So for example, we have, let's see, this company, they distribute suitcases to retail stores, and they extend credit terms of 115, net 30 to all of its customers. So any sale that we will see today on this Excel file will have those terms, okay? At the end of June, Ready, Set, Goes, inventory consisted of 120 suitcases purchased at $10 each. So during the month of July, the following merchandising transactions occurred. We need to make it, basically we need to write the journal entry for each one of these transactions. Okay? Now, for example, the first one is July 1st. The company purchased 150 suitcases on account for $10 each from trunk manufacturers, FOB destination, terms 210 at 30. The appropriate party also made the cash payment of $100 for freight on this date. What do we do here? So what do we have here? What's the economic event? The economic event so far is that the company purchased 150 suitcases, right? This is under the perpetual system, just to let you know. So under the perpetual system, what do we need to do? Remember, when you buy merchandise, what happens to your inventory? It goes up, right? So your inventory increases. What do you do when inventory increases? Debits, right? Okay. And then, did the company pay in cash? So it's what? Accounts payable. So it's inventory. And how much is the amount? It was 150. Let me just put this one here so you can get more space. Okay. So it's 150 or $10 each. So this is, I'm going to do it this way. 150 multiplied by 10. And the next account is, the account that was credited is accounts payable, the same amount. The explanation is purchase of merchandise for, you can put the term, purchase of merchandise, 150 suitcases if you want to specify, because sometimes they have more than one product. So you can have, for example, to be more specific, 150 suitcases at $10 each, and the terms were $210 net 30. So terms are 210 and 30. Okay? Next. The appropriate party also made a cash payment of $100 for freight. Who's paying the shipping here? It says FOB destination, so who's paying for the shipping? The seller. So do we make a journal entry for this one? No, we don't. Now the company sold on July 3rd. The company sold 110 suitcases on account to Satchel Word for $20 each. Whenever you have a sale, how many under the perpetual system, how many entries do you make? 2. When you make a sale, you make 2 journal entries. The first one is to recognize the revenue, to record the sale. The second one is to record the change in inventory and recognize expense. Right? Purchase. So when you buy something, like in the first one, you look at how much the company, the cost, how much the company pays. Right? And we debit inventory, we credit whichever we use. If we use cash, we credit cash. If we purchase on account, it's going to be accounts payable. In this case, July 3rd, the company has 110 suitcases. They sold 110, so sold, the sale was 110, right? Multiplied by 20. When you have a sale, the cost was $1,100. Okay? Now this is the information that we need to write the journal entry here. Sales. The company made a sale. So what do we credit? Sales revenue. We know that we are going to credit sales revenue. What do we credit? What do we debit? Did the company receive cash? Then it's account receivable. The amount is how much? We use the selling price. The selling price is how much? 110 multiplied by the selling price, which is 20. Right? So this is to record sale of 110 suitcases at $20 each. Next. What do you do next? What happened to the company's inventory? It decreased. So we know that we are going to credit inventory and debit cost of goods sold. Now, because we're talking about cost of goods sold and inventory, which is important, cost, you use cost, which was 1,100. So whenever we actually have a sale under the perpetual system, you make 2 transactions. The first one is for the sales revenue, and you debit either cash or accounts receivable. The second transaction will be what? Inventory and cost of goods sold. Okay? Now on the 9th, what happened? On the 9th, company paid the vendor in full. So you see, here you have to actually look at dates. We paid them July 9th. What were the terms of sale? 210. Was on July 1st. Is it within the discount period? Then the company will be paying the full amount minus discount. In this case, the company paid their full debt. Accounts payable was how much? Here, accounts payable was 1,500. Company paid cash. And here, what account do we use for the discount? Sorry? Inventory. And why is that? Remember, it's not discount. It's not purchase discount. It's inventory. Because what's happening is that you're decreasing the cost of your inventory. So the discount was how much? 2%, right? 0.02 multiplied by 1,500. Which is to mean this one will be 1,470. Okay? We continue to do that until you actually finish the whole thing. So in this case, for example, next, July 12, the company received payment in full from sexual work. Again, it was July 12. When did they sell them? July 3rd. You have to look at it and see if the company is going to receive any discount. If the buyer is going to receive any discount. Are they going to receive a discount? Look at it. The sale was made on July 3rd. The customer paid on July 12th. Then yes. Why? Because the terms are 210 and 30, net 30 for all the sales. So on July 12th, the company accounts receivable will be credited in full, right? So how much is the accounts receivable was? How much was the accounts receivable from that customer? 2,200. Discount was, in this case, what do you call it? So what do we credit? I'm sorry, we credited sales revenue. What do we debit? Sorry? Yes, but what's the name of the account? Yes, you're correct, but what's the name of the account? Sales discount. Just forgot the word sales. Sales discount, which is what kind of account? Bless you. Which is what kind of account? Is it an asset? Is it a liability? What is it? Okay, yeah, but what more specifically? Come on. It's a contra revenue account. What happened to studying after the chapter? Are you going to say the same thing during the exam? Hey, I got the first question, I'll have the remaining ones wrong. And then, no, let's not do that. So the discount and the remaining amount is in cash, right? The discount is 2%. So it's 0.02 multiplied by 2,200. And this one is equal to the full amount minus the discount. Right? This is basically how you solve the problems from the previous chapter. Okay? Do you have any questions? I will post the solution as well to this one. Today's chapter will be a continuation of the previous one. So basically what we will talk about today is how to calculate cost of goods sold and ending inventory. Okay? In the previous chapter, we were told that, for example, the cost of this inventory is such and such. Now we need to actually calculate it. So you see, so far, the assumption was that. The assumption was that all the units have equal cost. But is this true? So do you expect, for example, when Apple, or not, let's say, for example, Best Buy, when they actually purchase computers from LG, every time they purchase a computer, it will be the same price? In many cases, it changes, depending on demand, depending on so many things. So now the cost of inventory is different. Okay? The cost of inventory is not the same as for all items. So what will the company do? Think about it this way. The company had 3 TVs. They purchased the first one for $200. The second one, $250. The third one, $300. The company sold 2 TVs. Which ones? Which cost are they going to use? This is why companies, they need some kind of a mechanism to calculate the cost of those goods that were sold. Okay? And in this case, the company will use different methods, okay, depending on their own policies. Before we move on to talking about this, before we talk about those methods, how to calculate the cost of goods sold, we need to basically discuss a couple of things. This is a question that last time someone I think in this section or mentioned it, which was, what about the material that is being produced or manufactured? So usually there's basically a small difference between merchandising companies and manufacturing companies. Merchandising companies, they don't manufacture any products. So basically, they receive the goods, they buy them in a way that basically in shape that is already basically ready for sale. Okay? When Best Buy purchases from Samsung or LG, those CDs, they are already in the box and they are not being manufactured. They are already in the box, ready for Best Buy to sell to their customers. This is why they only have usually one kind of account of inventory, called just inventory. Now, manufacturing companies, they have usually different classifications or categories of inventory. So, for instance, they have the material that is finished. What do you call this? Finished goods, right? This is material that is being manufactured completely, it's ready for sale. You have the other part, which is work in process. For example, again, let's talk about Samsung, for example. They have those TVs that are already in boxes. This is finished goods. They have TVs that they are currently manufacturing. That's work in process. And then they might have also the raw material, plastic, chips, and all these items, all the electronics that go inside the TV. Okay? So they have different stages. They have this inventory in different stages. And usually companies, they would disclose what kind of inventory they have in the notes. And they mention basically, because you see the level of inventory, the difference between, for example, the raw material and finished goods can be very informative. Like, for example, a car company. You have the cars that are finished. They are already in the shows, basically in showrooms, etc. They are ready for sale. You have the cars that are already being manufactured right now, and then you have the glass and steel and tires and chips and all these the lights and everything that will go into production later on. So imagine, for example, that the company increases you see that there is an increase in raw material. What does it mean? What do you think when you see an increase in raw material? Why would the company increase their raw material? Yes?
We need more finished products.
Exactly, so to increase their production. So they want to increase their production. Okay? They want to step up their production. Say that, for example, they see that there is a market for trucks, and as a result, they want to increase production of their trucks. And decrease, on the other hand, the decrease in raw material. What does it mean? It means that the company believes that at this point they have a lot of finished goods, that they are not selling fast enough. They are producing faster than they are selling. and their finished goods inventory is increasing. As a result, basically, they are having more and more unsold trucks. So what would they do? They would decrease their raw material. Why? To slow down production. So you can look at this information, and then it will give you an idea of what's happening inside the company. Okay? We also talked about the two systems, perpetual system and periodic system. And we said that the perpetual system, after each and every transaction, the company would calculate the cost of goods sold and the change in inventory, right? Then in this case, why do companies who use perpetual system still run an end of year inventory, an actual physical inventory? We said that, what can someone give me an example? Yes, go ahead.
Because not everything is damaged.
Exactly, so it does not capture any losses, any fat, anything like that. It does not tell you exactly, basically it gives you what theoretically you have, but not what you actually have. Okay? So the companies, they do it for control purposes, to make sure that no one is stealing from them. On the other hand, periodic systems, they run this inventory for, the main reason is that they want to calculate the cost of goods sold. They want to be able to put a number next to that expense. Okay? They will also need to know their inventory level at the end of the accounting period. And taking inventory, like we mentioned last time, it's a very tedious work. So for example, companies who sell stuff by the weight, you have to weigh each item. Okay? They weigh everything they have. If they have counts, they will have to count one by one, each one of them. Now this is getting a little bit easier nowadays because there are certain advanced systems. Those advanced systems would allow, like for example, near-field communication. How many of you, or RFIDs, how many of you is familiar with RFID? So, what's RFID? How many of you have used an RFID, radio frequency ID? Okay, how many of you have ever driven a car using EasyPass? EasyPasses are RFIDs. What it does, it transmits information, your account, to the receiver, and that receiver will make it faster. What's faster? When you stop even if there was no traffic. You stop at the cashier, you pay in cash, etc., or if you just go through using EasyPass. Which one would be faster, more efficient? EasyPass. The same way, some companies, they are introducing those RFIDs and tags. So they tag their inventory. As soon as it reaches the warehouse, it is already entered in the system, it's captured and it's added. So inventory will be actual values. I'm talking about the actual values, not just the accounting values, the numbers. It's tagged and it's captured that this one arrived to our place. In fact, there was some controversy because NFC, near field communication chips, they carry more information than RFIDs, and I believe Walmart wanted to tag jeans. So basically, even if you buy a pair of jeans and then you go out, what might happen is that it automatically detects that information and makes it faster. So for Walmart, it's much more efficient. And why is that? They have stacks of jeans, right? So instead of coming and looking at the shelves and seeing, for example, that okay, we need more black jeans, size such and such. Instead of taking inventory and looking at it, an employee can go with a reader, RFID reader or NFC reader, and then they would just pass by. It would automatically collect information on, for example, how many items they have. If, for example, there is missing or shortage on one kind of product, the supplier will automatically be notified. So it minimizes the amount of work that is needed to be done by an actual human. What's the problem with that? Those tagged jeans, if for example later on you throw the tag outside your house in the garbage, someone outside can actually collect that information with a reader. You know that RFID readers, they cost like $20. And this is one of the problems. Have you guys seen like those wallets that they tell you that this is for credit card protection and all these things that are lined with aluminum foil or something like that? Right? This is called digital pickpocketing. You can be standing somewhere and someone behind you with a reader like that, they can actually read the information on your credit card and on your smart cards and stuff like that. And this is why a lot of cards now are introducing this chip which has encrypted information. It adds some kind of layer of security. The reason why I'm telling you I'm talking about this is that telling that companies are trying to minimize the work that is necessary to run a physical inventory. Because when they do run a physical inventory, they have, most of the time they pick a day where the sales are very low. Like for example, after Christmas or after New Year when the sales are at their minimum. And they actually count each and every item they have. Sometimes they close the business and they just run it. And it takes a long time. And when people count, people make mistakes. Whereas a computerized system, especially if it is tagged, etc., it will be more efficient. Now, inventory. There's also something tricky about inventory. It's not enough to just count what you have in your warehouse. You also need to look at what we call goods in transit. So what are goods in transit? Just from the name.
Goods that are on the way to be shipped out.
Goods that are on the way to be shipped. Or basically they are on the, think about it as they are on the delivery truck. Whether it's going from the company to their customer or from the seller to the company. Okay, it could go either way. Now who owns that? Who owns that inventory? So let's talk first about inventory that the company is shipping to their customers. Who owns that? Imran, you wanted to say?
Oh, if it's in transit, then the seller still owns it until it reaches the buyer.
So if it's in transit, the seller owns it until it reaches the buyer. It could be.
If it's already paid for, then the buyer owns it?
If it's already paid for, you mean the inventory itself was paid for. What if it's
in transit, we're already paid for.
so you paid in cash and still delivered, right? Okay. Actually, it depends on payment of the shipping. What about the shipping? If the shipping is paid by the seller, so this is the thing. If the shipping is paid by the seller, what do we call this? FOB. It's paid by the seller. FOB, destination. So when it's a free on board destination, it will be still the ownership of the seller until it reaches the customer. If it is FOB, shipping point, the customer paid for the shipping, ownership of that inventory will be transferred immediately when it is on board of the truck. So it's not always that it is the seller or it is the buyer. It's basically whoever paid for the shipping. Because until now it's still in their custody. They are responsible for it. If you buy something from Amazon, think about it like that. If you buy something from Amazon and they miss it, they never deliver it. Well, Amazon has a different protection thing, but generally speaking, if it is free shipping, basically you don't own it until it reaches your house. If you are paid for shipping, you own it even at the moment where it leaves their warehouse and it goes onto the truck. So remember that the goods in transit are the goods that either were purchased, okay, but the company hasn't received yet, or goods that the company sold but they have not delivered yet. Okay? Oh, by the way, in the Excel file that we're doing, just notice that for the sales, we have the sales discount as 2%. It says here that it is actually the terms of credit were 115. So if they were paid within 15 days, they will get 1%. See, I needed your help, guys. You did not help. Actually, it's difficult to keep scrolling up and down. Okay, so this is the one I was talking about here. This is the one I was talking about here. It's 115. It said, well, we use the 210 here. That was my bad. Sorry for that. So here is actually 0.01. Okay? Any questions? Now, there's one thing that I also wanted to mention here. You have also the returns. When you have returns, like the last one, remember, when you return under the perpetual system, this is why you have here two places. You have to do the sales returns, this is for the revenue, you have to account for the revenue, and again, for the change in your cost of goods sold and inventory. So it will be two journal entries. I forgot to mention that. Just remembered it now. Okay, now, we don't have a clicker. So today will all be considered as absent. Not mine. Your problem. I know. I know that, right? Actually, today you'll all get credit for it, so not to set out. However, you will have to participate. So you will have to, again, remember the first couple of days we did? Raise your hand whatever you see, you believe it's A, B, C, or D. So, goods in transit should be included in the inventory of the buyer when the public carrier accepts the good from the seller. Goods reach the buyer. Terms of sale are FOB destination. Terms of sale are FOB shipping point. Take 10 seconds to think about it and then we'll vote for it. Okay. Now, who's with A? B, C, D. Okay. I don't know what the percentage is, but I saw a lot of hands. Okay, so I'm going to give you a smiley face. Okay. There's no way of verifying that information. So this is actually what we talked about. It's basically when the ownership depends also on the shipping itself, okay? So this is where ownership passes, and this is where ownership passes when it's FOB destination. Now, we get to the point where there are also, oh, by the way, I forgot to mention about consigned goods. Do you know what consigned goods are? This is where, for example, the seller, okay, keeps someone else's inventory, someone else's products, and they sell them on their behalf for a fee. In this case, the consigned goods are not owned by the seller. So the easiest example to see is, for example, take like used cars dealerships, okay? If you put your car there, you still own the car, even if you put it in the dealer's lot. If they sell it, they will charge you a commission fee. But until you sell it, it's still your property. You can take it back anytime you want. This is the same thing. This is a consigned good. Okay? When the dealer calculates or basically their inventory, they're not supposed to include your car. That's your property. They only include the cars that they own. Okay? So this should not be included. Now, has been company completed its inventory count. It will have its total inventory value of $200,000. You have been given the information listed below. Discuss how this information affects the reported cost of inventory. So if the company included in the inventory goods held on consignment costing $15,000, they included that in their inventory. Is this correct or no? What would that do to the company's inventory? It will increase. So basically, their inventory was overstated by 15,000, right? What does the company need to do? They need to deduct it. They need to remove those 15,000. And then the company did not include in the account purchased goods for $10,000, where the terms were FOB shipping point. So FOB shipping point, who paid for that? The buyer. So they own them, right? Should they include them in their inventory? So they need to add that to their inventory. The company did not include in the account inventory, basically when they did the inventory, inventory that they have sold for $12,000 where terms of shipping were FOB, they were FOB shipping points. So who's paying for those goods? The buyer. Okay? They did not include them. So what would happen in this case? Nothing. It was treated correctly. So the ending value, the ending inventory will be basically 195,000. You'll need to add the 200, subtract 15, and so this is 200,000. Oh, sorry, it's 200,000. That's the original one. You add the 10,000 from this one, and you subtract the one that the company added mistakenly, the consigned goods. The last one, it does not affect inventory. Again, as we mentioned before, inventory is recorded at cost, right? So when you have inventory recorded at cost, what happens? What's the problem when inventory is added at cost? Again, the main problem is that those inventory that the company is buying, the merchandise that the company purchases, it's not always at the same price. If Best Buy purchased a batch of TVs in, say, March, and they purchased the same TV 3 months later, most likely the price of that TV will change, right? Sometimes it might go up, it might go down. As a result, we cannot treat them equal. So you need to basically, it's not that you cannot treat them equally. The idea here is that you need to find a way where you can, if you sell a certain number of TVs, you need to know which TVs they were. Now there are different ways. One of them is what we call the specific identification. Specific identification is where the company knows exactly which TVs were sold. If they know exactly which TVs they sold, can they actually know exactly the cost of each item? Yes. That will be easy. Okay? That will make sense. Say that, for example, you have TV 1, product 0001, product 0002, and you know the cost of each product. You can actually, when you sell TV 002, you allocate the cost of TV 002 as cost of goods sold, right? Now, this is easily done, doable when you have large, basically high value units. You have something expensive. A car, for example, the company knows exactly how much each car, from their VIN number, they will know exactly how much it costs. So they can allocate that cost, right? And plus, they don't sell like millions of cars every day or something, so they can actually trace it back to its cost. In certain cases, when this is not feasible, like if you're selling something cheap, basically a notepad, okay? A notepad. Are you going to actually trace back each item? In certain cases, it's not worth it. So what companies do is they use what we call the cost flow assumption. The cost flow assumptions, there are different ways of calculating that. They have the FIFO, first in, first out. In this case, if they, because usually companies, they try to sell their oldest products first to get rid of them. Because the longer it stays in your warehouse, the higher the probability or the likelihood that these products will be damaged or something like that. So they try to get rid of them first. So you have first in, first out. Last in, first out. This is mostly done with products that pile up. For example, when you have salt, you know those salt trucks when it's snowing? They will dump the salt on top of each other. It doesn't make any sense to try and get the salt that was underneath. You will simply take the ones that are on top, right? Same thing applies to hay, cement, things that sand, gravel, those are the products that pile up, okay? This is where companies might use last in, first out. And the third method is called average cost. This is where you calculate the cost of all the units, you divide it by the number of units that you have, and then you treat them all equal. It doesn't mean that you treat them equally. So although you might be selling, you might be allocating the cost, let's say $100, the actual cost might have been 110, but you take the average of all the items. Okay? So now we will be talking mostly, although this could be applied to perpetual and periodic with some differences, we will be doing the periodic system here because it's basically a little bit easier to understand and to grasp. Okay? So we'll be using the periodic system to calculate the cost of goods sold. So as an example, Privet's TV company purchases 3 identical 50-inch TVs on different dates at cost, 700, 750, and 800. During the year, Privet sold 2 sets of TVs. So this is the information here. In June, they sold 2 TVs. What's the cost that the company is going to use? Are they going to use 700? Again, here we're not talking about the sale. The sale is always the same. It's selling price. Now we're talking about the cost. Yes?
Can you make an average of your 750?
That will be one of the methods. This is what we call the weighted average. There's another way.
Oh, actually, I think I know the other way.
Yes.
You know which TV is worth which.
So this would be the specific identification method. So the specific identification method, you would know that this one, for example, this TV had product ID number TV001. This is TV002 and TV003. If you know, for example, that you sold, those 2 TVs were TV001 and TV003, then the cost is easy to calculate. It's 700 plus 800. What if you don't have this information? One way to do it is like let's say you take the average, the weighted average, but we'll talk about that in a second. There's another way that companies do, which is first in, first out. So they start like this. So they sold 2 TVs, they pick the first 2 TVs. It's 700 plus 750. Another way is last in, first out. They will start in this direction. It will be 800 plus 750. Okay? So it depends. There are different ways. And under GAAP, whether you use LIFO, FIFO, etc., those are acceptable by acceptable. Okay? So in this case, specific identification, this is what you talked about. This is what you mentioned. This is when the company actually knows which items were sold. You simply know that this is the item that was sold. You allocate the cost of that specific item. Okay? And in this case, the ending inventory is the one that was not sold. That's the cost of goods sold. And that's ending balance of inventory. Any questions? Do you guys understand the specific identification? This is where you know specifically which item you purchase. Okay? It works well with cars because you know for each VIN number, whenever you are selling a car, you know the VIN number of that car, you know exactly how much you bought it for. High value items. Now, just to let you know, this kind of inventory is kind of increasing now. It's becoming easier to do with computerized systems. Because if you have, like I said, if you have a company that uses a sophisticated inventory system where they actually tag each item from the beginning, they can actually trace it back to its own. They can trace it back to its own purchase date and amount and cost, etc. So they can actually know the whole history. When they sell it, it automatically traces it back and calculates the cost. Okay? Any questions? This is what we call the actual physical flow of goods. Okay, this is the exact TVs that were sold. This is the exact TVs that were sold. Okay? Most companies, they don't use this one, again, because of it's more costly. And this chart here shows you basically what companies use. Most companies, they use FIFO. You have also a lot of people who use LIFO and the average cost. There's also another kind of inventory that we'll talk about before sometime, which is called just-in-time inventory. Have you guys heard of just-in-time inventory? Has anyone bought something from a company who has just-in-time inventory? Anyone bought something from Dell? Seriously? Okay. Anyway, so basically, Dell, they have just-in-time inventory. They reduce the amount of inventory they have to keep, which is very beneficial in the IT industry, because usually those items or those products, so for example, the hard drives, etc., they lose value very fast, very quickly. So instead of having their own inventory, they link their system to their suppliers' systems. So when you call or when you place an order, even a customized laptop from Dell, Dell has linked their systems to each individual supplier. So when you place an order with, let's say, a 256 SSD hard drive, it will go to the manufacturer and it will request that part. And then it will also bring the memory, the processor, etc., and Dell will only do the assemblies. This is very helpful because it reduces the amount of inventory that the company needs to keep. However, this could be risky. Why is that? What might happen is actually it's not Dell, it's their suppliers. So the problem would be that their suppliers cannot handle that basically order, right? In other cases, for example, you remember, I don't know if you guys remember a few years ago, like I think it was 2 years ago or something, there was a problem which hit, I think, a lot of manufacturers of hard drives in Japan. That led to a shortage in hard drives around the world, and the cost of those hard drives skyrocketed. Now what happened? You place your order at a time where the hard drive was cheap. What does Dell do now? They still have to honor it, right? But they have to buy the hard drive at a much higher price, and that will lead to them not basically making profit as much as before. And in certain cases, what if they cannot actually find that hard drive at all? Then it will be another problem. So this is good, but it's also tricky. The trick here is to have some very reliable suppliers. And Dell is very good at that. Dell has one of the best just-in-time inventory systems where they don't have actually to order stuff in advance. Okay, so this is the information that we will be using to illustrate the three methods: FIFO, LIFO, and average cost. Okay? So here the company purchased 100 units for $10. Not that they had 100 units at the beginning of the year. And then they purchased 200 units for $11, $300, $12, and $400 for $13. Okay? The total cost is always known. The cost of goods for sale. Do we know it? Yes, this is whatever the company had originally. They know they had bills for that. They have those invoices, so they know exactly how much they paid. And they know exactly how much they purchased during this year. So the total units available for sale and the total, basically the cost of goods available for sale, this is known information. The trick is to calculate the ending inventory and the cost of goods sold. In this case, a physical count of inventory at the end of the year showed that they had 450. So the value of inventory will be the value of 450 units. The cost of goods sold will be the cost of 550 units sold. Okay? We start with FIFO. In FIFO, like we said, this is where the company would sell the first items that they receive. So the first items to enter the warehouse are the first items to leave their warehouse. And most companies they actually have this in real life. So it does actually, it is the best after the specific identification. Remember, specific identification is the most accurate one, but it's costly, so sometimes companies don't use it. When they use an assumption or estimation, so this is more like an approximate number, okay? The approximate number will be to calculate the ending inventory and the cost of goods sold based on the first items to be that were purchased will be the first items to be sold. Okay? So let's see how this is done. We have the units that were sold. How many units do we have in total? 1,000, right? We have the cost of goods available for sale. Did I say the units that were sold? The units that are available for sale were 1,000, and the total cost of those 1,000 units we already know. What we need to calculate is the cost of goods sold to recognize the expense and the ending balance of inventory. Once you know one, you know the other. With FIFO, it's usually, just remember that. Companies, they usually start by calculating ending inventory because most of the time it's easier to look at the ending inventory than it is to calculate cost of goods sold. Usually companies, they sell a lot more than what they have at the end of the year. In this example here, the company sold, as you can remember here, the ending inventory was 450. So ending inventory is 450 units. How do you calculate that one? When you say that first in, first out, those are the first in, the first out to be sold. So when you talk about selling them, you are selling them in this direction, right? So when you actually, what are the ones that would be remaining at the end in your ending inventory? From the end backwards, right? So the ending inventory will be actually like this. This is ending inventory. Okay, so with ending inventory, what's happening here is that, let's say that you had TVs 1, TV 2, TV 3, 4, and 5. You sold 3 TVs. Which one are you going to calculate as cost of goods sold first? 1, 2, 3, right? 1, 2, and 3. Your ending inventory will be the latest ones. So for ending inventory will be TV 5, TV 4, until you reach the number that you have. So this is in this direction, the ending inventory. Let's calculate ending inventory in this case, in our problem here. Company had 450 units. You start with this one here first, okay? You can take from the 400 units, how many can you take? 400. So you have 400 multiplied by 13. Then how many do we still have in our ending inventory? 50. Where do we take them? From the second bin, from the following bin, from this one. What was the cost? 12. So it will be 400 multiplied by 13, and 50 multiplied by 12. So this is the amount here. That will give you what? Ending inventory, right? We calculated ending inventory. How do you calculate cost of goods sold now? Subtract this amount from this one. So you have 12,000 minus ending inventory. It will give you the cost of goods sold. We got the two parts of that one. Okay? This is the idea here. This is the first batch. It was for $13 each. This one, the second batch, was for $12 each, etc. We took only 50 out of that. We did not take the whole thing. Those parts, the remaining ones, are the cost of goods sold. Any questions about that? So sometimes, actually, sometimes they call it last in stays here. So first in, first out, okay? It's the same as last in stays here, okay? The ending inventory, you start backwards. Start from the end backwards. This is what will remain. LIFO is the other way around. This is where you actually start selling the newest item, the newest purchases. So in this case, you have TVs 1, 2, 3, 4, and 5. You sold 3 TVs, selling 1, 2, 3. 4 TVs is 4. So if we say we ended up with 1 TV, you start from this one here. Ending inventory will start from here. Ending balance of inventory will start from here. Okay? So let's calculate this one. Once again, you always do it this way. Calculate ending inventory, and from that one, you calculate cost of goods sold. And by the way, just to show you here, if for verification purposes you wanted also to do that, you can do it the other way around. We know that we sold 550 units. First in, first out, 550 units. So how did we sell them? It was 100. You take all these, 100 multiplied by 10. Then we have 200 multiplied by 11. How many do we still need? Those are 300. We still need 250. So 250 multiplied by 12. If you do the math, it will still be 6,200. Now let's do LIFO. Okay? So let's calculate the ending inventory. Which ones? Again, we have 450 units in ending balance. Which ones do we start with first? Because we sold the latest ones, the ones that are going to remain in our warehouse will be the earliest purchases. So you start from the beginning, from the earliest ones, and you move forward. So this is how we calculate the ending balance of inventory. So ending inventory is like this. Ending inventory. You start by having how many? Come on. Sorry? We have 450, right? So which one do you start with? It is, you said 1,000, right? $1,000. That's correct. But let's do them in numbers and multiply them by its value so that we'll see which ones. So we have 100 multiplied by 10. Then we have 200 multiplied by 11. How many do we still need? 150. So it's 150 multiplied by 12. Okay? So you have 100 multiplied by 10, 200 multiplied by 11, and we have 150 multiplied by 12. That will give you ending inventory. Subtract that amount from the cost of goods available for sale. It will give you the cost of goods sold. As you can see, the cost of goods sold and the ending inventory, they have different values when you use LIFO and when you use FIFO. This will have some implications later on income and on taxes, etc. Yes,
So,
Lord.
depending on whether you use LIFO or FIFO, it's just the company's like, structure that is.
The company's policy. It's the company's decision to use FIFO or LIFO. They have to use it more or less consistently, but they have the right to switch. However, when they switch, they have to disclose that information. They have to say that we changed from LIFO to FIFO, and this is how it affected net income. Because sometimes companies might use that information to improve their net income or to decrease net income when they want to pay less taxes. Okay? But you always, to calculate that, you always do that, you'll always do cost of goods available, which we have it, we can easily calculate it, this is the sum of everything, minus ending inventory will give us cost of goods sold. Or if you want to use it the other way around, cost of goods available minus cost of goods sold will be ending inventory. Because sometimes you might have one information in the other, it depends on which one you can use. Again, for verification purposes, when it's an easier problem like that, you can always double check. We do cost of goods sold. We can calculate it one by one. We have 550. So we are going to take 400 from this one. It's going to be 400 multiplied by 13 plus how many? 150 multiplied by 12. That will give us the same amount. Yes?
Is this just a way to put it, or are they actually selling units like TVs here?
No, actually, that's an excellent question, Katrina.
TVs that are like old forever and
That's an excellent question. It does not have to follow the actual flow of goods. So this is just a calculation method, but they don't really. It doesn't mean that they actually sold the first ones or they actually sold the last ones. Most of the time, they just put them all in the stack and then they start just picking whichever they sell. Okay? They said that they have those notebooks, the notebooks that you're using, or pencils, or something like that. It doesn't matter which ones they sell. So they don't actually sell the first ones first and last ones. Most companies try to do it this way, because even if it was the same product, if you leave the old product in the warehouse, it might collect dust, humidity, etc. It loses its value. But at the same time, does this happen where they sell actually the newer parts first? Yes, like when I said, like for example with salt or sand, they are going to sell whatever is on top. It will be actually following last in, first out. But that's a good question. So just remember, this calculation does not mean that it is actually, that this is actually how the goods are being sold. We're not saying that it actually happened this way. In fact, the company can use either LIFO or FIFO or average cost. Okay? Now, the average cost is the weighted average cost. So here, you don't just take the average of all the items. So if you take the average here, it will be 10 plus 11 plus 12 plus 13. So that's the average. However, we cannot use it directly because you bought different numbers of units with each batch, right? So for example, the way to calculate the average per unit, the weighted average per unit, you look at the total cost of goods available for sale. This is how much it costs to buy all these items. And you divide that by the total number of units. You have 1,000 units. That will give you the value of these items. per unit. And then you multiply that by the amount of units that remained or the amount of units that you sold. So in this case, you have to calculate first the average, so the weighted average will be equal to 100 multiplied by 10 plus 200 multiplied by 11 plus 300 multiplied by 12 plus 400 multiplied by 13. What would that amount be? 12,000. So this is 12,000. You divide this one by the total number of units, which is 100 plus 200 plus 300 plus 400. It would be 12,000 divided by 1,000, which is to mean that the costs, the average cost per unit is equal to $12. So the ending inventory is how much? 450 units, right? So ending inventory is equal to 450 multiplied by 12. Cost of goods sold, you can either calculate it as 550 multiplied by 12 or 12,000 minus ending inventory. Sorry? Yeah. Ending inventory is this one here. So you have one of two ways to calculate them. You either calculate them simply by multiplying the number of units that remain or number of units that were sold, okay, by the average cost. Okay, in this case, you're saying that, okay, well, I'm simply taking the average, but not just the average, the weighted average. Any questions? Okay, so the cost flow method that often parallels the actual physical flow of merchandise is FIFO, LIFO, average cost, or gross profit method. Who's with A? B? C? D?